Right now, as we speak, the live trading tape for Nubaru Inc., ticker symbol BURU, is flashing a price of 20 cents per share. The stock is currently down 0.57 cents, representing a decline of 2.71% for the intraday session so far. If you are watching the order flow on your screen, you are seeing a classic battle of attrition in the microcap space, where every fraction of a cent represents a massive percentage swing for the day traders involved. The chart right now isn't just a red line. It is a visual representation of uncertainty, a standoff between those who see a company on the brink of irrelevance and those who believe they are holding a lottery ticket stamped by NASA. When you look at a stock trading at 20 cents, the immediate expectation is that the business is fundamentally broken, that the lights are about to go out, and that this is nothing more than a speculative vehicle for retail traders on the Robinhood app trying to catch a falling knife. That is the expectation, a zombie company waiting for the final nail in the coffin. But the reality is drastically, confusingly different. This 20-cent stock is currently the only company in the world with a scalable, high-power blue laser technology that has been actively contracted by NASA to figure out how to beam electricity wirelessly across the surface of the moon. This isn't science fiction. It is a funded contract. The reality is that while the stock chart looks like a disaster, the underlying physics of their technology solves a manufacturing bottleneck that giants like Tesla stock and the entire electric vehicle industry have been struggling with for a decade. The disconnect between the share price, which suggests a company heading for zero, and the technology, which suggests a foundational shift in how we build batteries and explore space, is one of the most extreme divergences you will find in the market today. This creates a curiosity loop that we have to pull apart. How can a company with revolutionizing technology, in the truest sense of the word, though we won't use that buzzword, be trading for the price of a gumball? To understand this, we have to look past the ugly red number on the screen and dig into the mechanics of what is actually happening. Let's look closely at the intraday action we are seeing right now. If you are executing trades through a sophisticated platform like Interactive Brokers Trading Workstation, you can see the depth of the book. At 20 cents, liquidity is often a mirage. You might see a stack of buy orders at 19 cents and a wall of sell orders at 21 cents, creating a narrow channel where the price bounces like a pinball. This volatility is characteristic of stocks that have undergone significant dilution, which we will discuss later, but it also signals a lack of institutional conviction. Fidelity Investments managers and large institutional desks typically cannot touch a stock trading at these levels due to compliance mandates. This leaves the price action almost entirely in the hands of retail speculation and algorithmic high-frequency trading bots that scrape for fractions of a penny. When you see a drop of 2.71% on a day with no specific negative news, it often indicates exhaustion selling. Long-term holders finally giving up hope and exiting their positions to harvest a tax loss. However, for the contrarian, this capitulation is exactly where things get interesting. The volume profile today suggests that while people are selling, someone is quietly absorbing that supply. To understand why anyone would buy this, you have to understand the blue laser thesis. Most industrial lasers used in manufacturing today, the kind used to cut steel for cars or appliances, are infrared lasers. They operate at a wavelength that is invisible to the human eye. Infrared lasers are fantastic for cutting steel, but they are terrible at welding copper. Copper is highly reflective to infrared light. It acts like a mirror. When you try to weld copper with a standard laser, the energy bounces off, or you have to blast it with so much power that the metal explodes and spatters, creating a low-quality weld. This is a massive problem because the entire green economy is built on copper. Electric vehicle batteries, wind turbines, and high-efficiency motors are all essentially giant bundles of copper wire. When you think about Tesla stock and the production hell they often describe, a significant part of that difficulty comes from the physical limitations of joining copper parts quickly and reliably. This is where Nuburu enters the picture. They developed a high-power blue laser that operates in the blue spectrum of light. Physics dictates that copper absorbs blue light 13 times better than it absorbs infrared light. It doesn't reflect, it melts. This means a blue laser can weld copper quickly, cleanly, and with a fraction of the energy required by legacy systems. This is not just a marginal improvement, it is a step change in manufacturing capability. If you are an engineer at a company looking to build the next generation of solid-state batteries, you almost have to look at blue laser technology. The expectation from the market is that Nuburu is just another laser company in a crowded field. The reality is that they possess a proprietary stranglehold on the high-power blue laser diode market that is extremely difficult for competitors to replicate without infringing on a dense thicket of patents. So if the tech is so vital, why is the stock at 20 cents? This is where we have to have a sober, smart friend conversation about financial structures. A great product does not always equal a great stock, especially in the short term. Nuburu has faced a brutal cash crunch. Building lasers is capital intensive. You need factories, expensive raw materials, and highly paid physicists. To survive, the company has had to raise money repeatedly. In the world of finance, when a company needs money and the stock price is low, they often have to issue new shares at a discount. This dilutes the existing shareholders. If you owned 1% of the company a year ago, you might own a tiny fraction of that today, even if you never sold a share simply because the company printed millions of new shares to pay the bills. This is why users on the Robinhood app or SoFi Invest might see the stock down 90% over a longer time frame. It's not necessarily that the technology failed, it's that the share count exploded. But recent developments suggest the company is trying to pivot from a pure R&D shop to a defense and aerospace contractor, which changes the investment thesis entirely. They recently closed a capital raise of roughly $12 million. While this caused more dilution, hurting the stock price in the immediate term, it provided the runway needed to execute on their new contracts. And these aren't just any contracts. We need to talk about NASA. Nuburu was awarded a Phase 2 contract by NASA to develop power beaming technology. This sounds like something out of a comic book, but it is a serious logistical necessity for lunar exploration. When we send rovers or habitats to the moon, they rely on solar power. But the moon has a 2-week-long night cycle, and there are craters at the poles that are in permanent shadow. These craters is where the water ice is, so that is where we need to go. But how do you power a rover in the dark? You can't run an extension cord from the sunny side of the moon. Nuburu's solution is to shoot a high-intensity blue laser beam from a power station in the sun, aiming it directly at solar panels on the rover in the dark. The blue light transfers energy wirelessly. Because blue light diffracts less than other wavelengths over distance, the beam stays tight and focused. This capability creates a Fidelity wealth management style long-term value proposition that is completely ignored by the day traders fighting over fractions of a penny right now. Furthermore, the company has been aggressive in entering the defense sector. They recently announced a strategic joint venture with Maddox Defense and an acquisition of a company called Orbit to create a defense innovation hub. This move is critical because defense contracts are sticky. Once you're designed into a military system, the government tends to keep paying you for decades. This offers a potential floor to the revenue volatility that has plagued them. If they can successfully transition their blue lasers into directed energy weapons or optical communication systems for the military, the current valuation of the company would look absurdly low in hindsight. Now, let's pause here for a moment. I want to hear your take on this specific application. Comment below if you think power beaming, shooting lasers to transfer energy, is going to be a viable technology in our lifetime, or if it sounds too much like science fiction to ever be profitable. I read every comment, and I'm genuinely curious if you see the utility here. Now, let's get back to the market analysis. When you compare Nuburu to other stocks popular with retail investors, like those found in Schwab Intelligent Portfolios or widely discussed on SoFi active investing forums, you see a distinct difference in risk profile. Most speculative tech stocks are software companies. They can scale with zero marginal cost. Nuburu is a hardware company. They have to build things. This makes the turnaround slower and more painful. The